Trump just rejected Iran's ceasefire proposal, and the market's reaction tells you everything you need to know about where we are right now. Oil jumped 3%. Equity futures are down. Risk-off sentiment is spreading across Wall Street like cold water. And here's the kicker. This is exactly the kind of headline that makes algorithms panic and humans reach for the sell button. Welcome back to TechMeHome, MarketPhase Daily News. I'm your host, and today we're walking through one of the most consequential geopolitical moves in months and what it means for your portfolio. Let's start with the raw facts. Trump rejected Iran's peace proposal this morning. No negotiation, no middle ground. This wasn't a maybe, it was a hard pass. Now, traditionally, Middle East escalation equals market headwind. When bombs could be flying, investors don't want to hold risky assets. They want cash. They want gold. They want treasuries. Anything that doesn't blow up if things go sideways in the Persian Gulf. That's the playbook, and the market is executing it right now. Oil up 3%. That's your canary in the coal mine. When geopolitical risk spikes, the first thing that moves is crude. Why? Because the Middle East controls global oil supply. If things escalate, if shipping lanes get blocked, if refineries get hit, suddenly energy becomes scarce and expensive, and energy touches everything. Gas, heating, plastics, food transport, your electricity bill. Think of the global economy like a massive machine powered by oil. You pull the plug, even a little bit, and the whole thing starts to sputter. But here's the thing. Most retail investors panic without a plan. That's where platforms like Vested come in. Vested lets you automate your defensive positioning during these exact moments. Set alerts for geopolitical spikes, rebalance your portfolio away from energy-heavy sectors, lock in some bond exposure. It's protection you can set and forget. Protect yourself while others panic. Now, let's talk equity futures. They're down this morning. Not catastrophic, but down. The reason is simple, risk-off. Hedge funds and institutions are taking profits off the table. They're saying, hey, maybe now's not the time to be long small-cap tech or speculative growth stocks. That's defensive thinking. And defensive thinking spreads fast in these environments. But here's where it gets interesting. AI stocks didn't crater. Semiconductors, memory chips, the supply chain plays, they're holding up. We saw Micron rally. SK Hynix rallied on Samsung's production troubles. Even that mystery stock up 240% year-to-date is holding its own. Why? Because AI is the meta-narrative right now. It's bigger than geopolitical risk for some investors. It's bigger than oil. It's the story everyone believes in, and when money believes hard enough, it can override bad news, at least for a while. Let me explain this simply. Imagine you're at a casino. The dealer just announced there might be a fire alarm soon, meaning uncertainty, chaos. Most players are cashing out their chips and heading for the door, but if you're already all in on roulette red, and you've been winning all night, you might stay in the game anyway. That's what AI investors are doing right now. They're not leaving the table. They're doubling down because the momentum is real. The Sony-TSMC joint venture for image sensor manufacturing, that's capital flowing into semiconductor expansion. This deal says, we're building more capacity because AI demand isn't slowing down. That's a vote of confidence against the geopolitical noise. It's a bet that escalation doesn't actually happen, or if it does, it won't derail the AI supercycle. So where does this leave you as an investor? First, monitor the news cycle. Iran escalation could move fast. If it does, energy stocks could surge another 5% to 10%, but equities overall could pull back another 1% to 2%. That's the trade-off. Second, don't panic sell tech on a red day. The fundamentals haven't changed. Third, if you're underweighted in defensive sectors, utilities, staples, bonds, maybe this is a good time to add a little bit of ballast to your portfolio. Not because the sky is falling, but because uncertainty demands respect. Fed Chair. Powell's recent comments are also in the mix here. His messaging seems to be shifting expectations around rate cuts. If the economy stays resilient and geopolitical risk doesn't spiral into actual war, the Fed might hold rates steady longer than markets expected. That's good for bonds, bad for rate-sensitive growth stocks. It's a complicated picture, which is why markets are confused today. Here's the MarketPhase take. We're in a moment of bifurcation. Risk-off in equities, but AI and semiconductors holding their own. Geopolitical risk is real, but not catastrophic yet. Oil is up, but not at crisis levels. The Fed is hawkish, but not panicking. You're not in a crash scenario. You're in a stay alert, stay diversified scenario. That's the mode to be in right now. Keep watching the headlines. If Trump escalates further, if Iran responds, if US military assets move into position, that's when things get real. Until then, treat this as a volatility day. Volatility is opportunity for patient investors. It's also risk for those who panic. Stay sharp, stay diversified, and come back tomorrow for the next chapter of this story. None of this is financial advice. This is purely for entertainment purposes. Always do your own research, consult a licensed financial advisor, and never invest money you can't afford to lose. I'm your host. This is TechMeHome, MarketPhase Daily News. See you tomorrow.